Okay, problem 5 on Connect. This is exercise 811 in your text. This is issuing stock for cash. And as usual, we have to wade through the verbiage. Here they're telling you what a company did, but they're giving it to you from the perspective of the investor. So this investor paid $20,000 for 1,000 shares of stock, $10 par. A month later, he bought 2,000 additional shares at $25 per share. The key here was you had to see that they flipped it, that you were looking at it from the company's point of view, but they gave you the information from the investor's point of view. They then ask us to show the effect of these two stock issues on the company's books, not the investor's books, because very few investors actually keep books on their investments. I don't know of any. I'm sure some do, but I don't know of any. And they want us to, in the cash flow column for the company, indicate whether this would be an operating activity, an investing activity, or a financing activity, or not at all. Well, at this point, you were sophisticated enough to know that if you got cash, not at all isn't an option. So we can cross that one out. You also know that the company's not in business to sell stock, so it can't be an operating activity. And it can't be an investing activity, because investing activities are when you purchase property, plant, equipment, boats, planes, automobiles, buildings, stock of another company, bonds of another company. So it can't be that. So if 3 of the 4 are wrong, I think we know that everything we're going to be talking about here is a financing activity. So we can get that nonsense out of the way right away. They're financing activities. Okay, now let's see what happened. They sold him 1,000 shares which I carefully wrote down as 10,000. Sorry. See, if you had gone to Penn, you would have got a math professor that can do math. 1,000 shares at $10 par. So that's 10,000. But they sold it to him. The selling price was 20,000. So the additional paid-in capital was the difference between these two, or $10,000. So we have $10,000 common stock, and we have $10,000 additional paid-in capital, and we have $20,000 in cash. So that's the first piece we need. So our cash, $20,000. Our common stock, $10,000. Our additional paid-in capital, $10,000. This has nothing to do with revenue, expense, or net income. But yeah, if you got $20,000, I'm assuming that we had some cash flow of $20,000. Now the next thing they tell us is a little while later, they sold him 20,000 shares of the same stock for $25. So let's start with that. So the selling price is $25 times 20,000. So that's $50,000 was the selling price. The par is $10. So we have 25 times, we have $10 times the 20,000 shares, or 2,000 shares, 2,000, not 20,000. So 10 times 2,000, that's $20,000. That's par. And the difference between those is the additional paid-in capital. So we now have that piece. So cash, we got $50,000. The common stock at par, $20,000. The additional paid-in capital, $30,000. So you see we got those numbers. They sold him 2,000 shares at $25 a share. That's $50,000. The par value of those 2,000 shares was $20,000. The additional paid-in capital was $30,000. That's also called capital paid in excess of par. It's the same thing. So that's the second transaction. That's number 2. And number 1, they sold him 1,000 shares. 1,000 shares for $20,000. They give us that number. And we then had to figure the par. 1,000 times 10 is 10. And the additional paid-in capital was $10,000. So as usual, the hardest part of any of this, and this of course is neither revenue nor expense nor income, is wading your way through the accounting drivel.